Hi, so welcome to the stream today, the session 2 of our live mentorship session where we are solving practical questions on the examination, looking at the chief examiner's report and having discussion about the key issues that we need to focus on, and most importantly, how we apply the practical principles in respect of the various issues or questions that we are going to be seeing in the exam hall. We started with a discussion yesterday, so in case you missed the session 1, you can check the channel for yesterday's video to be able to see that. It was also going to be available in the description, the second link in the description of this video on YouTube, so that you can watch that as well in that case. So we are getting straight up into the discussion for the day. I see some of you guys joining. You are welcome. Give us a thumbs up on the video when you join, and also remember to share the video with your colleagues. Anybody doing financial reporting or corporate reporting, we are taking ourselves and discussing the various issues about the various accounting standards, and so you want to share the video in your WhatsApp groups sorry, and your Facebook pages and all that. Let's get as many students as possible joining and coming on the stream as we continue with our discussion. So going to pull up my stream straight up, and then my presentation slide straight up, and then we get excited into the discussion coming up in 3, 2, 1. Okay, there we go. So in the session 1, we looked at the first 2 notes. That is IFRS 15, accounting for accounting for sale or return transactions. And then we looked at IAS 16, revaluation of assets, and most importantly, how we deal with transfer of assets. So we're going to be going straight up into notes 3 and start a discussion from there. And we saw the breakdown of the various things that we need to understand. So we're going to just build it up from there. So notes 3, just for so you know, this is March 2025, the ICA March 2025 examination. You can download a question on the ICAG website under past question segment. It's there. You can download a question and get access to it. So let's go to note 3 straight up in our discussion. It says that during the year, Halidu sold some plant that cost 120 million on 1st December 2020. During the year, Halidu sold some plant. Now, we got to be mindful here. During the year here means during the year ended under review, which is the 30th June 2024. So during that year ended, Halidu sold some plant that cost 120 million on 1st December 2020. So it means this 1st December 2020 was the date of acquisition of the asset. Because if you're not mindful about the way the grammar is structured, you may think that during the year and then on 1st December 2020, you may think the 1st December 2020 is actually the date of disposal of the assets. No. But as I said, during the year means the year ended 30th June 2024. And then the 1st December 2020 there is the date of acquisition of the asset, because it says Halidu sold some plant that cost 120 million on 1st December 2020. Stay with me carefully here. It says the proceeds of these sales were 72 million, and these have been credited to cost of sales. Hold up. Proceeds from the disposal of assets aren't credited to cost of sales, meaning that it has been subtracted from cost of sales, right? Then it says that no other entries have been made relating to the disposal. No other entries have been made relating to the disposal. So what do we do? Before we get excited, number one, we need to correct the error that has been committed. Because proceeds from the disposal of an asset, double entry is we debit our cash book, then we credit disposal of assets account, not crediting cost of sales. So since they have recorded that 72 million in cost of sales, you want to go and add that back to cost of sales to reverse that error. So we come to cost of sales, and we're going to reverse that transaction, proceeds from disposal. They had credited it, so we come and debit the cost of sales back to reverse that transaction. $72,000, because we are working 3 zeros up. So we come and add it back. Okay. Now, I need you to pay attention carefully here. Let's look at the rest of the thing we have here. It says then that plant and equipment is to be depreciated on the reducing balance basis at the rate of 20%. Now, if assets are disposed of, it is important for us to find out about the carrying amount of the asset at the date of the disposal. So the question we ask ourselves is, what is the carrying amount of the asset at the date of the disposal? Now, it says reducing balance basis for depreciation of plant and equipment. Stay with me. Then it says, Halidu charges full year's depreciation in the year of acquisition and none in the year of disposal. That is very important there. So unlike the normal depreciation where we're going to go with 1 month ownership concept, where we will say that, okay, when we charge depreciation based on how long the asset has been used from the date of acquisition, here the rule is simple. In the year of acquisition, full depreciation is charged irrespective of whether it was used for only 3 days, 1 month, or 2 months. But in the year of disposal, you don't charge any depreciation at all. So let's go into the discussion and work ourselves through. So that will be working 6. And I need you to stay with me carefully here. So what did we sell? We sold plant. So plant disposal. So we want to get a carrying amount of the plant that was sold. All right? So we bring in the initial cost of the plant at 1st December 2020 as indicated. And they said the cost was 120 million. We are working 3 zeros up. So that's going to be 120,000. Then we will less the depreciation for the year. Remember, the entity's year ended is 30th June. So if the asset was bought on 1st December 2020, it means we less dip, all right, for the year ended 30th June 2021. That'll be the first year. Now remember, we are told that depreciation is charged at 20%. So we take 20% of that. So 20% of the 120,000 to see the answer we get. That's 24,000. So that we get a carrying amount at 30th June 2021. And that's 96,000. Then we work for, because remember, our current year ended is 30th June. And that is the year they are selling. So we have to work up to, our current year ended is 30th June 2023. So we have to work up to 30th June 2022 to be able to get ourselves out in that regard. So that is the first year. Then we less the depreciation for 30th June 2022. Reducing balance basis, so still 20% times 96,000 being the carrying amount, right? Because depreciation on reducing balance basis, we charge the depreciation on the carrying amount. So 20% of that, I'm getting 19,200. So we take it out, and that gives us the carrying amount at 30th June 2022. We still have one more year to go because our year ended is 30th June 2024. So that figure from 96,000, we get 76,800. All right? Then we less the depreciation for 30th June 2023. Again, depreciation is on a reducing balance basis. If it was in a straight line, we wouldn't have been going this way. 76,800. And that is 15,360. So that we can get a carrying amount for 30th June 2023. And that is going to give us an amount of 61,440. So this is the carrying amount at the end of 30th June 2023. Remember the principle that we are dealing with here, because the last sentence in this question is really changing the game for us. It says, Halidu charges a full year's depreciation in the year of acquisition and none in the year of disposal. So in the year ended 30th June 2024, which is our current year ended, there will be no depreciation charge because that is the entity's policy. No depreciation is charged in the year of disposal. So we're not going to charge depreciation for the current year ended. Then you remember that the asset was bought on 1st December. So under normal circumstances, we would have charged depreciation for December, January, February, March, April, May, June. 1, 2, 3, 4, 5, 6, 7. That would have been 7-month depreciation for the first year up to 30th June 2021. But the policy of the entity is we charge full year depreciation in the year of acquisition. None is charged in the year of disposal. That is principle and application of the principle. So now that we have the carrying amount, we can simply bring in the proceeds we had, which we canceled out earlier, 72,000 from the cost of sales. And the balancing figure becomes the gain on disposal, which is 10,560. All right? That's gain on disposal. And that will go to P&L. Sounds good? That will be taken to profit or loss. So the portion of the property or the portion of the plants that was disposed of, this is how we work for it. This is how we work for it. Now remember, I was telling you earlier that we could have, if we wanted journal entry movement, it would have looked like this. Let me just show you that. The concept is that we would have prepared plant disposal account. Okay, so when we prepare plant disposal account, you will credit the plant with the carrying amount of the assets we are disposing of. Then you debit this. So you bring in the carrying amount, which was the figure we had here, 61,440. Then the proceeds that we had, we would debit our bank or cash and then come and credit the asset disposal account, 72,000. And then the balancing figure is on the debit side. That is why it is called profit, because it will go to the credit side of the P&L account. Okay, that is the idea about that. So gain on disposal. So that is how the journal entry is supposed to be like, and we got a gain of 10,560. That's it. So that was why we mentioned earlier that in the question they said, oh, the proceeds had been entered or credited to cost of sales. We don't credit the proceeds to cost of sales. The proceeds has to be credited to the plant or the asset disposal account. So that is why we have to go back to debit the cost of sales, add it to cost of sales, and credit the plant disposal account to reflect or show what exactly is happening for the period under review. That is the idea about asset disposal. But we are not done with this note, because there is plant and equipment, as you can see here. So a portion of this has been disposed of. So we need to work our way out and then fix the issue at the end of the day. So let's go into it. So we're going to go to plant and equipment proper. Now, the cost of the plant is available here, as you can see. This is the cost of the plant, 1,200,000. Then we have accumulated depreciation there. So there are a couple of ways I could present myself if I want to. I can have the cost, then I can have the accumulated depreciation also worked on separately. So we bring in the, okay, let me stay this way. Let me just work with the cost item here into bracket cost. So we bring in the initial cost, and that is having an amount of 1,200. Then we're going to less what we disposed of. So we less the cost of the plant we disposed of. The plant we disposed of in the note, we are told, is 120,000. So that's going to be less. All right. Now we are not done. Maybe there will be other notes about plant that we need to deal with. Then on the accumulated depreciation side of things, as well, we'll bring in the balance brought forward, or the balance at 1st July 2023, which is in the trial balance at 225,000. Right? 225,000. But remember that the plant that we disposed of, its depreciation over the last 3 years is also included in this accumulated depreciation. So what do we have to do? We have to less this out. So we less the accumulated depreciation on plant disposal. And that will come from the workings we did. So we add all the 3 depreciations we did over the 3 years. 24,000 for the first year, 19,200 for the second year, 15,360 for the third year, and that is 58,560. That's going to be taken out. Because once we are looking at, I believe you are getting the idea, right? Because we are looking at calculating depreciation for the current year on the asset that has not been disposed yet. So if you bring the cost of 1.2 million, we have to subtract the cost of the plant that has been disposed of. So we now get the cost of the plant that we can charge depreciation on. Same thing happens to the accumulated depreciation. The total at the beginning of the year is 225,000. However, that 225,000, you have to know as an accounting student that it includes the depreciation over the last 3 years of the plant we disposed of. So since you are disposing it off, you have to deduct it as well from the accumulated depreciation. So if you put that together in principle, the way the idea works is that you credit PPE with a cost and debit the asset disposal account. Then you debit accumulated depreciation with the depreciation on that asset and credit the asset disposal account so that you bring the proceeds, then the balancing figure become the profit or loss at the end of the day, or the gain or loss on the disposal of the asset. So that is the idea there, and we'll come back to this because we don't know, probably there will be some additional footnotes about the plant that we have to deal with. But for now, that is the note 2, IAS 16. So split it into two, the disposal part, so that we can get gain or loss on disposal. Here it is a gain, so we work it out. Then the remaining plant that has not been disposed of, okay, that is part of our assets. Now, so plant and equipment after disposal, that's what we are working for now, so that we can do the calculation that has to be done in that case. Note 4. The license is being amortized. Now, immediately I hear about license, what comes to our mind? IAS 38, intangible assets. And if you remember, when it comes to intangible assets, on subsequent measurement, they can be carried at the historical cost or the cost model. They can be carried at the revaluation model. Under each of the model, it can happen that we will carry it, we will use straight line method, or meaning that we amortize the cost over the useful life, or better still, what is going to happen is that we are going to be charging or testing for impairment of the intangible asset. So that is why IAS 38 always goes with IAS 36. So on subsequent measurement, if the intangible asset has a definite economic useful life, then the cost is going to be amortized over the economic useful life. But if the intangible asset has no economic useful life, then we don't amortize it. Instead, we test for impairment. In this case, it is a license. We are told it's being amortized, so there wouldn't be any impairment stories here. So on a straight line basis, at a rate of 20% per annum. So let's go back to the trial balance and see license. Okay, so let's go to the next workings. License. So we bring in the initial cost for the license. In the trial balance, the figure there for license in the trial balance, let me pick something else, is 240,000. All right, 240,000. Then we see the amortized cost over the year. So we less accumulated amortization at 1st July 2023, which is the beginning of the year, 96,000. So we take it out to give us the carrying amount at the beginning of the year. So what do we have? That's 144,000. All right. Then we less the amortization for the current year. June 30th, 2024. What did they say? They said it's on a straight line basis at 20%, meaning it's on the cost. So we're going to take 20% on the cost. And the cost of this intangible asset is 240,000. Right? So you got to be mindful. This is not reducing balance basis where, like the plant where we calculated the depreciation on the carrying amount. Here, straight line method means we will express the percentage on the cost of the asset. So 0.2 by 240, we get 48,000. All right? So we take it out so that we can get a carrying amount at 30th June 2024, which will go on the face of the statement of financial position. 96,000. Very simple, sweet, straight to the point. All right? No headache, no worries here technically. Then he says, all depreciation and amortization is to be charged to cost of sales. Okay, so now the examiner is telling us where we should take depreciation and amortization to. So let's go to cost of sales. Remember, we had workings for cost of sales here. So we're going to bring in the depreciation of the building. Then we're going to bring in depreciation of plant and equipment. Then we're going to bring amortization. So depreciation, building, depreciation, plant and equipment. Then we will bring in the amortization. So let's see. We've worked for the building here from workings 5. Depreciation for the year, 36,000. We add that to cost of sales. Because double entry for this is credit PPE, debit P&L. And so you are adding it to cost of sales. Cost of sales is an expenses, has a debit balance. So we are debiting cost of sales. Equipment. We've not calculated depreciation for equipment yet. We'll come to that. But we just did amortization, working 7 on the license, which is 48,000. All right, 48,000. That is the idea about that as well, and that is the footnote. 4, we are done with it. Very simple, straight to the point. Let's continue. Note V. It says, the directors have estimated the provision for current income tax for the year ended 30th June 2024 to be this amount. Okay, so this is where IAS 12 comes in. So how much income tax must go to the P&L account? Okay. The balance on the balance of taxation in the trial balance relates to over or under provision of tax in the previous year. So let's go to workings 8, income tax. I'm going to do T accounts here. You could do vertical presentation, but I want to do OG T accounts, you know. Gen Zs don't like T accounts. But this is the old school, you know what I'm saying? So if you come back to the trial balance, you can see taxation here, 12,000. It's on the credit side. It's on the credit side. That's an over-absorption of overhead. Sorry, that's over-provision, okay, of tax. So it is going to reduce the current tax chargeable because it's on the credit side. And so in my T account, I just say, balance brought forward. It's on the credit side, so I take it to the credit side, 12,000. Then we pretend to close the account. Then we bring the provision for the current year, which is what was given in the note to be 76,200. Okay? So in the trial balance, what is on the credit side represents over provision of tax. And over provision of tax arises because the entity paid less tax than it had provided for in the previous year. And so over provision of tax is an income, but we don't recognize it as an income. It will just reduce how much tax we are supposed to charge into the P&L account in the current year. So it is going to affect the current year tax figure. If it was on the debit side, then that would have been under provision of tax, which means that in the current year, the entity paid more tax than they had provided for to pay. You know, taxes are paid 1 year in arrears. That is why there will be over or under provision. So if it was on the debit side, that would have been under provision of tax, and that means there is more expenses to be charged, and so that will increase the income tax figure for the current year in the P&L account. So that is the idea about how we deal with those over and under provision of tax. Then there is a last sentence there that says, the only deferred tax consequence relates to those mentioned in Note II above. What was Note II? Note II was what we discussed in the session 1, which was the revaluation of the property issue. Remember, when properties are revalued, there will be deferred tax implication. And so we have to calculate the deferred tax on it at the end of the day to see what is happening there in that case. And so the company pays a tax on profit at a rate of 25%. And deferred tax will go to the OCI. Technically, will be charged to the OCI at the end of the day in that case. Now, the beauty of this is that, as you can see here, we do not have anything like net asset or carrying amount of the asset and the tax base of the asset. But what is going to be happening is that to get the income tax, we are going to be going back to the workings we did on the property, and we were going to be charging the tax in respect of the revaluation surplus that we had. That is the figure that is going to be expressing the tax in that case. Now, let's see if we have any opening figure for the deferred tax in the trial balance. Revenue, cost of sales, loan interest, There is no deferred tax in the trial balance. All right? So since there is no deferred tax in the trial balance, it means that we are going to be going straight up, and then whatever maybe show that here. So the balancing figure from this will go to P&L account. Let's balance it. 76,200. 76,200. Now, let me explain this even before we go. Sometimes the examiner will tell you that deferred taxes should be charged to the P&L. If the examiner says that deferred tax charged to P&L, then you charge to P&L. But if the question is quiet, like it is in this case, then deferred tax will usually be charged in the OCI. So it's not going to have a P&L implication here for us. And so we balance this to get the charge for the year, which is what will go to P&L accounts. So the balancing figure, I could do that. 64,200, I guess. Yep. That's the income tax figure that will go to profit or loss. The income tax figure that goes into profit or loss. But we need the deferred tax liability. That will go to the OCI. Okay? And that will be based on our revaluation surplus. The rate given to us, the company pays a rate of 25% times. The deferred tax implication will come on the revaluation surplus. And this is something you have to be mindful of, because normally we would have had the written down value brought forward or the taxable difference. But we don't have the taxable difference here. So, because the deferred tax has to be calculated on the taxable difference. And so the concept here is that the taxable difference is going to become what? The revaluation surplus. Because that is what is bringing us to carry the asset above how it may have been accounted for by the tax authority. All right, so the revaluation surplus here is 465,000. So we're going to take 25% of that. And this will be charged to OCI. And that is 116,250. So if you pay attention closely, what it means is that when we go to the OCI, the revaluation surplus 465,000 will go there. Then we'll subtract this 116 there. So in our statement of profit or loss and other comprehensive income, this is going to be there. We're going to get there. Then you're going to see how it goes. So that is the note V and what we can do there, IAS 12. Now remember that as a financial reporting student, if you are going to go into the examination, whether you like it or not, you must know everything about IAS 12. It's there, whether you're preparing cash flow or you're preparing normal P&L, as in this case, you must know IAS 12. Not only that, you must know his brother, IAS 16, property, plant, and equipment, because whether I like it or not, there will be IAS 16 there, property, plant, and equipment. Then certainly the other key issues between IFRS 9 and then IFRS 15, one of them almost always is going to be lurking around, because again, these are crucial accounting standards and the examiner wants to pick your brain about them. And then certainly the other non-current asset accounting standards. So that is note 5 and what we can do there. Note 6. Halidu intends to dispose of a major line of its business operation, in the course of the year. At the date, the held for sale criteria were met. At the date the held for sale criteria were met, the carrying amount of the asset and liabilities comprising the line of business were as follows. Okay. This is IFRS 5, non-current asset held for sale and discontinued operation. The standard says that once the entity wants to sell, we sell. Now, this has meaning. The S means management have decided to sell. Okay? Management have decided to sell. That's the first thing. A means that the asset is available for sale. What does that mean? It means the entity is no longer using the asset. The asset has been put into a saleable condition. 3, the entity has located a buyer or is looking for a buyer through advertisement or advertisement. E means that the entity expects the sale to be completed within 12 months. Okay? Management expects sales to be completed in less than 12 months. So in accordance with IFRS 5, non-current asset held for sale and discontinued operation, this is how we This is the recognition criteria. Sale. So if we are told here that, at the date that the held for sale criteria were met, these are the carrying amounts. So this is an operation that they want to dispose of. So what do? We go to workings 8. Held for sale operation. Now, the standard says that for held for sale operation, they must be carried out lower of cost and net realizable value. Any impairment must be charged into the P&L account. So let's see the carrying amount of the held for sale at the date of the disposal. We have plant and equipment. So a portion of the plant and equipment is going. Which is 138,000. That means it's part of the plant and equipment to be disposed of during the year. If you remember the note we read in note 3, for plant and equipment, the year of disposal, depreciation is not charged. So we go back to plant and equipment workflow here. Then we will less the held for sale. The plant and equipment in held for sale. Because we will not, it's no longer there for us to charge depreciation in held for sale operation. And that is an amount of 138,000. Are you getting the picture? Because it is now being sold. And per the entity's policy, the date of disposal, no depreciation shall be charged. So the cost of the plant that relates to the operation to be sold must be deducted from our plant and equipment, so that we will get the plant and equipment that the entity is now using in the business on which depreciation must be charged. Then the next thing there is trade receivables, okay? So it means we have to go and adjust trade receivables as well, because this is no longer there. So trade receivables, 9,000. That's an asset. So if you remember, we opened trade receivables somewhere in workings 2. So we're going to less the held for sale. Okay, 9,000. So this is no longer part of our normal trade receivables because we are selling the business. We are selling that division. Then trade payables. Okay, that must be subtracted because that's a liability. So let's trade payables, 7,000. So that we'll get a carrying amount of the operation that we are selling. Now, what that means is that trade payable also, we hadn't done any adjustment to trade payable. But if you go to the trial balance, there is trade payables here. Trade payables. So on the face of the statement of financial position, we are going to be subtracting that figure of trade payables, 7,000, from this, the 1120. Because again, that amount of trade payable also relates to a segment of the business that is being sold. You're getting the idea, right? So all the assets, the liabilities, that relates to the portion of the business, the line of the business that is being sold, must be deducted from the carrying amount of everything we had at the reporting date, because it's no longer there. So what is the carrying amount here? 138,970. That's 140,000. So the carrying amount of the operation that the entity wants to sell is 140,000. But what is the realizable amount? Let's continue to read. It says, it is anticipated that Halidu will realize 35 million for the business. No entries have yet been made in respect of this information. So the 135,000 is the net realizable value. Non-current asset held for sale must be carried at lower of cost and net realizable value. So the net realizable value here is 135. If you check, it means that we must carry this held for sale operation at the net realizable value 135,000 so that the balancing figure becomes impairment, which we can charge to administrative expenses 5,000. So now when we go to the statement of financial position, the held for sale operation will go under current assets. So when we bring inventories, trade receivables, held for sale operation will come in, all right? And we will carry it at the net realizable value of 135,000. So that this 5,000 will be an impairment that will go to the P&L account. We are not told where exactly it should be entered, but by default, we can take it to admin expenses. We can't take it to cost of sales, so we can take it to admin expenses. Or you can also take it to cost of sales. You wouldn't be punished, but the concept here is that this is about the sale of the business. Cost of sales is about the cost we incurred in a run in the cost that relates to the core activities that generate sales for us. Now, certainly this is not a core activity generating sales for us, so cannot be part of cost of sales in that case. Hence, it will be prudent for classification purposes to have it under admin expenses. As I said, in some cases, the examiner will say put it under cost of sales. Here it is quiet, so we're going to put it under admin expenses. So in the trial balance, how much do we have for admin expenses? In the trial balance, you can see this above here, admin expenses. 118,800. So as per trial balance, okay, 118,800. Then we're going to add the impairment. From workings 8, the 5,000. That's it. So we can go back to go and read or finish up with the plant and equipment, the depreciation on that. So now let's get the cost of the plant after disposal. 120,000. 138,000. I'm getting 942,000. Okay. Then let's get accumulated depreciation. In that case, 225,000 minus 58,560. 166,440. Okay. Now remember, depreciation on plant is charged on reducing balance basis. So permit me to quickly just do something here. I want to take this to the next slide. So that I will less accumulated depreciation, which is this figure, 166,440. So that we get a carrying amount that we can charge depreciation on. So minus 942,000, 775,560. Then we'll charge the depreciation for the year, which is, what was the percentage of depreciation? That's coming from note 3 on the plant and equipment is 20%. So 20% on 775,560. That's 115,112. And that's going to be taken out so that we get a carrying amount that will go on the face of the statement of financial position. And that is 620,440. 620,440. That is the idea about that in that case. Give me a sec. Let me just see. Want to make sure that okay. So that is the idea there in that case, and we are done with the notes. So you realize that in this workflow, if we come back, we got a revenue to be adjusted, and so we can get a total of the revenue, 3120,123 minus 62,400. That gave us 30,576,600. So 3,057,000. Trade receivables, 259,200, 62,400, 9,000. 187,800. Then we can clean up cost of sales here for us to get the amount of cost of sales. 17,574,400 minus 48,000 plus 72,000 plus 36,000 plus 48,000. Then the depreciation on plants that we just calculated. The depreciation on plant that we just calculated. Give me a sec. Let's see my depreciation on plant. Okay. Did I take a wrong figure for plant and equipment? Yeah. The initial cost for plant is not this. Oh. The main plant and equipment, this is the figure. 1,011,600. Oh God. It means that I just screwed up myself a little bit here. So give me a moment. We could fix this quickly. Those are some of the things, right? You pick a wrong figure and then you are screwed. 1,011,600. So 1,011,600. So if we work that out again, 1,011,600 minus 120,000 minus 138,000, and that is 753,600 minus 166,440. That's 587,160. So 587,160. We will do 20% of that, and that is going to give us, our depreciation is 20%, right? Oh God. 1,011,600 minus 120,000 minus 138,000. 753,600, okay. Then we will have our accumulated depreciation. Please give me a moment. I want to make sure that we are on the same page. Okay, this was accumulated depreciation. Let me see. Did I pick the wrong? Look at me. I'm picking some wrong figures. Oh, the property. I'm picking the figures for the properties as the plant and equipment. That's why I'm screwing up my figures. So plant and equipment accumulated depreciation is actually 291,600. Oh, God. The boy is bondelism. 291,600. So we less 58, 560, and that is 233 and 40. So we bring that here, 233 and 40. And then we take that for 753,600. And that is 520, 560. So the 520, 560, 20% of it, 104, 112. So that is actually the depreciation for the plant and equipment. So that is taken out from 520, 560. And that is 416, 448. So 104, 112, that is what is going into the cost of sales for depreciation on the plant. 104, 112, so that we can add that up for the cost of sales to get a figure. 1,757,400 minus 48,000 plus 72,000 plus 36,000 plus 104, 112 plus 48,000. And that is 196, 9512 in that case. So these are the workflow. These are the workflow. Now, the beauty of all this is that once you're able to do these workings, apply the accounting standards, then you don't have a problem. Then you don't have a problem at the end of the day. But if you're not able to read the notes, work with, and you're doing all these in 36 minutes, because it's a 20-mark question, right? So 36 minutes. So speed, accuracy is going to be important here. So those are the workflow. Inventory, we are getting a closing balance of 112,800 plus 48,000. And that will be 160,800 for inventory. What else? We are done. Disposal of assets, the gain on disposal, we've calculated it. PPE, we just did the correction. Depreciation, licenses, income tax. These are the workings. Okay? These are the workings. So start from here, slide 1 there, in that case. Then the slide 2, fix it there in that regard. Slide 3 for the inventory, and then the land and building situation in that case. The slide 4 is the plants that we dispose of, the way we did the workings, applying the standards, and then looking at the workings also for the annual transfer that we did from the revaluation surplus to the retained earnings. Slide 5, presenting the plant and equipment that remains after the disposal, right? That remains after the disposal. Then getting the depreciation by lessing the depreciation on the asset that has been disposed of from the accumulated depreciation brought forward, so that we can get the depreciation for the continuing assets. licenses, income tax, deferred tax workflow, in that case, then certainly the held for sale and admin. So maybe the admin now, our current amount for admin will be 118,800 plus 5,000. And that is 123,800. So these are the core workings that we need to do in that particular case. Once you are done with these workings, the financial statement presentation is not going to be an issue. So I'm going to just go straight to the solution to the financial statement pro forma and then show you and confirm across board. So look at the revenue figure here. So in the P&L, we bring our revenue. What was the answer for our revenue? 30,57,600. What do we have here? 30,57,600. So that is checked. Cost of sales, because we have to less cost of sales. What did we get for our cost of sales? 1,969,1,512. That is also checked. So when we subtract the cost of sales from the revenue, it gives us the gross profit arithmetically. Then profit from the disposal, which we did workings for, if you remember here, profit from the disposal, 10,560. That is what is here, 10,560. Distribution cost, nothing was mentioned about it in the notes, so we'll just pick what is in the trial balance. Then admin expenses, we worked for it. If you remember, admin expenses, 123,800. What do we have here? 123,800. So when we less all of those, we get operating expenses on the arithmetic side of things. Then finance cost will come. In the context of this question, was there any loan? Yes, you can see in the trial balance, there is loan interest paid. That is finance cost. Okay? Now, you want to be careful about the workflow here because you can see 12% loan notes issued on 1st July 2023. So 12% on the 240,000, what do you have? That is 28,800. Okay. Now, the reason you want to do that workings is because what will be paid may be different from what is supposed to be charged for the year. The 28,800 is what is supposed to be charged for the year. Coincidentally, it has been paid already, so no problem. Assuming we did the workings and what is supposed to be charged for the year is greater than what has been paid, the balancing figure will be recognized under current liabilities as interest owings. That's very important. That's very important. But here we don't have such headache. Luckily for us, what has been paid is what has been recognized. Then the income tax, we got 62,400. From our workings, income tax, 62,400. It means we're good. Then the other comprehensive income. Now, you could see here that the examiner chose to, do a certain presentation and say, gain on revaluation net of tax. We could break that down a little bit by bringing it separately. So, revaluation surplus, and then we'll bring the deferred tax. We'll work it out and you see we'll come around with the same figure. So the deferred tax was 116,250. Okay. 116,250. That's going to be subtracted. Then the revaluation surplus we had on the property was 465,000. Okay, 465,000. So the net of that, because these are the OCI items, 465,000 minus 116,250. That gives us the 348,750. That is what you are seeing here. So it's just about presentation. The examiner decided to bring the net as one-liner item, but we should bring the items individually in the OCI. But that is the idea about that. Now, just so you know, this 348,750, when we go to the statement of financial position, revaluation surplus will be that figure less the annual transfer we made. The 13,500 annual transfer we made, because the annual transfer is made from revaluation surplus here, the workings we did. So that 13,500 there will be taken out so that now the carrying amount of revaluation surplus on the face of the statement of financial position will be 335,250. Now, let's see if that was what was there in that particular case. We are seeing, plus the opening figure, because there was an opening figure for revaluation surplus. If you remember, that adjustment would have been done in the statement of changes in equity workflow. Remember, we prepared a statement of changes in equity, right? So that adjustment would have been done there in the statement of changes in equity in that case, so that you get a carrying amount and bring it up. So that is your P&L account. So the main financial statement is not an issue. It is about your ability to read a note, apply the principles as we have done. And that is the accounting standards. You must know the accounting standards. You go to the statement of financial position, you will find the same workflows that we have done. So now you have property, plant, and equipment put together. Licenses, we worked for it, 96,000. Licenses, 96,000. We got that figure. Held for sale, we worked for it, 135,000. Remember I told you the 135,000 is what will go under current asset. We did that. Inventory, we worked for that, 160,800. 160,800 from workings 4. So the problem is not the financial statement itself. Okay, look at receivables. We worked for it, 250, 200. Where is receivables? Here, in that case, what are they having? They are having 250, 200. Did I miss anything? Give me a moment, let me see. Receivables. Starting, 529,200. Okay, so it could be just an arithmetic issue. Let me just go ahead in that regard. So the financial statement itself is not an issue. It's not an issue. Look at the deferred tax. I told you it will come in the statement of financial position. We worked for deferred tax. If you remember, here, 116,250, it goes to non-current liability. So the financial statement is not an issue. Your issue is, how do I understand the accounting standards? How do I know to apply the accounting standards? How do I work with speed and accuracy? And these are the things. And as I mentioned yesterday, the chief examiner's concern on these scripts are that students must thoroughly understand the accounting standards. And so you realize that to be able to excel in this particular question we just solved, you should have been strong in IFRS 15, revenue from contract with customers. You should have been strong in IAS 16, property, plant, and equipment. You should have been strong in IAS 12, income tax. In that case, you should have been strong in your principle of IFRS 5, non-current asset held for sale. There's an element of impairment there, IAS 36, subsequent measurement, the treatment of impairment in that case, in the question. Right? Then, did I miss anything? I don't think so. Hold up, let me just go back into the slide. What I miss in a standard again. Then I mentioned 38 in that case. So to solve this 20-mark question, you are calling on 16, 12, IFRS 15, IFRS 5, IAS 36, IAS 38. 6 accounting standards. Just 6. Sometimes you could have 8 accounting standards to be applied in that 20 marks area. So it is not about the question is difficult. It's about understanding the accounting standards, and you will be in the position to pass the examination. So this is a guinea pig freestyle of how the standards, you're supposed to understand them, and then how you apply them in given questions in that particular case. And the accounting standards are pivotal when it comes to your ability to be able to go into the exam hall and pass the examination. And so, as I mentioned yesterday, you want to make sure that you understand the accounting standards. Get tutored, get the best guidelines you need on the accounting standards. It doesn't end there. Expose yourself to questions. Solve questions outside the ICAG past question. Don't download from ICA 2010 to 2024 and say, oh, I have solved all the past questions, I'm good. No, go outside the past questions. Then work on speed and accuracy, because everything rises and falls on the accounting standards, and you must know them thoroughly in that particular case. So this is the idea about this, and I'm going to wrap up here today. And on our next session, we will look at something else, bringing together the knowledge of the examiner and what concerns the examiner has raised, and also crystallize the discussion by taking a question and seeing how practically the principles can be applied. So thanks for watching, and I'll see you on the next episode as we continue with our discussion.